Unemployment on the rise, a cause for concern. The unemployment rate is a key indicator of economic health. It measures the percentage of the labor force that is unemployed and actively seeking employment. Recently, the unemployment rate has been ticking upwards, sparking concerns about the possibility of another recession. A rise in unemployment can have a ripple effect throughout the economy. When more people are out of work, consumer spending tends to decline. This is because unemployed individuals have less disposable income, leading to reduced demand for goods and services. Businesses, in turn, may experience lower profits, leading to cutbacks and potentially further job losses. A sustained rise in unemployment can create a vicious cycle that is difficult to break. It's important to note that the unemployment rate is just one data point, and it's crucial to consider it in conjunction with other economic indicators. Factors such as inflation, interest rates, and consumer confidence all play a role in shaping the overall economic outlook. While a rising unemployment rate is undoubtedly a cause for attention, it's not necessarily a guarantee of an impending recession. Echoes of the past 2000 and 2007 in retrospect. To understand the potential implications of a rising unemployment rate, it's helpful to look back at previous economic downturns. In both 2000 and 2007, the United States experienced recessions that were preceded by periods of rising unemployment. In the late 1990s, the dot-com bubble led to unsustainable growth in the tech sector. As the bubble burst, unemployment began to rise, eventually reaching a peak of 6.3% in June 2003. Similarly, the 2007 to 2008 financial crisis was triggered by a collapse in the housing market, which led to widespread job losses. The unemployment rate surged to 10% in October 2009, marking the highest level since the early 1980s. These historical examples highlight the importance of monitoring the unemployment rate as a leading indicator of economic health. While the current rise in unemployment is concerning, it's essential to remember that economic conditions are constantly evolving. It's too early to say definitively whether we're headed for another recession, but the parallels to previous downturns are worth noting. Manufacturing slowdown. The ISM PMI sends a warning. The Institute for Supply Management ISM Purchasing Managers Index PMI is another closely watched economic indicator. It measures the performance of the manufacturing sector, which is a significant contributor to the overall economy. A PMI reading above 50 indicates expansion in the manufacturing sector, while a reading below 50 signals contraction. Recently, the ISM PMI has come in below expectations, raising concerns about a slowdown in manufacturing activity. A weakening manufacturing sector can have broader implications for the economy, as it can lead to job losses, reduced investment, and slower economic growth. The decline in the ISM PMI is partly attributed to ongoing supply chain disruptions, rising input costs, and labor shortages. These factors are putting pressure on manufacturers, making it more challenging for them to meet demand and maintain profitability. The slowdown in manufacturing activity is a worrying sign that the economy may be losing momentum. Section 4. The yield curve inverts, a recessionary signal. The yield curve is a graph that plots the yields of bonds with different maturities, typically ranging from 3 months to 30 years. Normally, the yield curve slopes upward, meaning that bonds with longer maturities have higher yields than bonds with shorter maturities. This is because investors typically demand a higher return for tying up their money for a more extended period. However, when short-term interest rates rise above long-term interest rates, the yield curve inverts. An inverted yield curve has historically been a reliable predictor of recessions. This is because an inverted yield curve suggests that investors are pessimistic about the economy's long-term prospects and are willing to accept lower returns on long-term bonds. The recent inversion of the yield curve has heightened fears of an impending recession. While the yield curve is not a perfect predictor, its historical accuracy has made it a closely watched indicator for economists and investors alike. Section 5. TLT seeking safety in troubled times. During times of economic uncertainty, investors often flock to safe haven assets such as US Treasury bonds. The iShares 20-plus year Treasury Bond ETF, or TLT, is a popular exchange-traded fund that tracks the performance of long-term US Treasury bonds. When investors anticipate a recession or a stock market decline, they tend to move money into TLT, driving up its price. TLT has historically performed well during economic downturns. For example, during the 2008 financial crisis, TLT gained over 40% as investors sought safety in government bonds. Similarly, during the COVID-19 pandemic-induced recession in 2020, TLT surged by more than 20%. The recent increase in TLT's price suggests that investors are becoming more risk-averse and are seeking refuge in safe haven assets. This is consistent with the other economic indicators discussed earlier, which point to a potential slowdown in economic growth. Section 6. Volatility spikes. A bearish omen or a buying opportunity. Market volatility, as measured by the CBOE Volatility Index or VX, tends to increase during times of uncertainty or fear in the stock market. The VX is often referred to as the fear index because it reflects investors' expectations of future market volatility. Sharp spikes in the VIX can indicate that investors are becoming more concerned about the outlook for the stock market. However, contrarian investors often view spikes in volatility as potential buying opportunities. The logic behind this approach is that when fear is high, asset prices may become oversold, creating opportunities to buy stocks at discounted prices. It's essential to remember that market timing is notoriously difficult, and trying to catch the bottom of a market decline can be risky. While volatility spikes can create buying opportunities, it's crucial to have a well-defined investment strategy and to avoid making impulsive decisions based solely on short-term market movements. Section 7. Conclusion. Navigating the path ahead. The confluence of a rising unemployment rate, a weakening manufacturing sector, an inverted yield curve, and increased market volatility suggests that the economic outlook is becoming more uncertain. While these indicators do not guarantee a recession, they warrant careful attention from investors and policymakers alike. Navigating the current economic environment requires prudence and a long-term perspective. Investors should focus on building well-diversified portfolios that align with their risk tolerance and investment goals. It's also essential to stay informed about economic developments and to be prepared to adjust investment strategies as needed. The road ahead may be bumpy, but by staying focused on the fundamentals and avoiding emotional decision-making, investors can position themselves to weather potential storms and achieve their financial objectives.